Record foreign capital exodus from China's stock market. Chinese turn to gold for self-preservation. Economic downturn. Shanghai's 72-year-old historic department store announces closure. Faced with heavy mortgage loan burden, middle-aged Chinese are selling their homes and renting again. Powell. China's economy facing challenges, shifts away from market-led growth model. It's all covered in today's China Truths. Record foreign capital exodus from China's stock market. Chinese turn to gold for self-preservation. The ongoing real estate crisis in China, coupled with the continuous decline of A-shares, has led to significant withdrawals of foreign investors from the Chinese market. This trend has set a record for 6 consecutive months of net selling of Chinese stocks, reflecting growing concerns about the Chinese economy among global investors. The news of the Chinese Communist Party's plan to establish a 2 trillion yuan, approximately $281 billion, stabilization fund briefly boosted stock markets in China and Hong Kong 2 weeks ago, only to see them turn downward again last week, with 5 consecutive days of decline. On February 2, A-shares experienced a sharp fall, with the Shanghai Composite Index dropping 3.77% to a new low since March 2020. This decline was mirrored in other indices, with the Shenzhen Component Index and the Chinext Index both falling 4.85% at one point. Over 5,000 stocks in all A-shares fell by more than 6% during the week. Foreign investors have been actively selling off Chinese onshore stocks, with global funds selling a net of 14.5 billion yuan, around $1 billion worth of stocks through southbound trading in January alone, setting a record for 6 consecutive months of selling. This cumulative selling since August last year has reached 201 billion yuan, approximately $28.3 billion. According to the Institute of International Finance, IIF, net foreign holdings of emerging market bonds totaled nearly $179 billion in 2023. While emerging markets other than China saw a net inflow of $261.1 billion, China experienced a net outflow of bonds totaling $82.2 billion. NTD TV anchor Len Lan noted that this is the longest and strongest outflow of foreign capital since the inception of the Shanghai Hong Kong Stock Connect and Shenzhen Hong Kong Stock Connect initiatives, signaling a negative outlook for China's medium and long-term economy. Not only foreign investors, but also mainland Chinese consumers, have felt the chill of the sharp economic downturn. To hedge against the financial crisis's uncertainties, people have been buying and hoarding gold in significant quantities. Even the People's Bank of China has joined in on this trend. According to the Global Gold Demand Trend Report 2023 released by the World Gold Council on January 31, total gold demand in 2023 reached a record high of 4,899 tons. Central banks globally purchased over 1,037 tons of gold, second only to the 1,082 tons in 2022, marking the second highest figure since 1950. Among these purchases, the Central Bank of China bought more than 225 tons of gold on a net basis, the highest level since data collection began in 1977. Based on the Independent Precious Metals Authority LBMA's PM current gold price, as of the end of 2023, gold was priced at $2,078.40 per ounce, setting a new year-end closing record and boasting an annual return of 15%. The average price of gold in 2023 stood at $1,940.54 per ounce, also reaching a new high and marking an 8% increase from 2022. China's investment demand for gold, including bars and coins, surged by 28% to 280 tons, largely offsetting a sharp decline in Europe, as per the report. Although global demand remained steady, China's gold jewelry consumption increased by 10% last year, totaling 630 tons. Speaking to the Epoch Times, a Beijing resident named Song Tao, pseudonym, stated that many Chinese people turn to gold purchases due to past experiences with fraudulent financial products in the declining property market. They may see it as an opportune moment to invest in gold. Many believe that physical gold offers a sense of security as it's tangible. Most ordinary folks aren't concerned about gold stock prices, they opt for purchasing gold bars to safeguard their wealth. Xia Tian, an expert on Chinese affairs and a marketing professor at the University of South Carolina's Aiken School of Business, emphasized to the Epoch Times that Chinese individuals buy gold out of concerns about the country's economic future. Xia Tian noted, they fear that the bursting of the housing bubble and stock market collapse could lead to significant RMB depreciation. In times of uncertainty, gold serves as a traditional store of value. Economic downturn, Shanghai's 72-year-old historic department store announces closure. On February 5, the long-established department store Shanghai Lubai, founded in 1952, announced its closure, sparking concerns about the economic downturn in Shanghai, the largest economic city in mainland China. The announcement stated that from the current date until February 18, 2024, a large-scale gratitude promotion event would be held, with the store officially closing its doors after business hours on the 18th and ceasing operations from February 19 onwards to commence the demolition and reconstruction of the building. If there are remaining points in consumers' VIP cards, they are advised to redeem and use them in-store before the closure. Netizens lamented the closure, citing the decline of other major stores like Pacific, Harbor City, and Oriental Plaza. Employees face layoffs amid final severance payments. The Zhujiaoui Business District testified about another old department store's exit, following the closure of the Shanghai Pacific department store Suhui branch. Reporters observed promotional banners inside Shanghai Lubai, but there were few customers due to the cold weather and the fact that it was a workday. Nearby malls, including Pacific Department Store, Oriental Plaza, and Huilink, have either closed or transformed. Shanghai Lubai opened in 1952, and has been rumored to be demolished since 2021. The city's economic decline, influenced by factors like foreign capital withdrawal, worsened post-pandemic. The foreign investor exodus, reinforced by policies like the zero-COVID strategy and the counter-espionage law, contributed to Shanghai's economic woes. A survey by the American Chamber of Commerce revealed declining optimism among member companies. Despite expectations, 2023 didn't bring the anticipated rebound in investor confidence, leading to further market reevaluation. On July 22, 2023, a netizen named Kengqiang Yantang posted, "We are all very sad about the situation in Shanghai." The article described the most prosperous Nanjing Road pedestrian street in Shanghai, saying that the entrance of the Grand Landmark Plaza was deserted, euphemistically called upgrade and renovation, with only a few upper floors operating, and hardly anyone would go there. Faced with heavy mortgage loan burden, middle-aged Chinese are selling their homes and renting again. Amidst the burden of mortgage payments, more and more middle-aged individuals in China are selling their homes and transitioning to renting. In the current economic downturn, with reduced incomes among the populace, middle-aged individuals find themselves struggling to keep up with mortgage payments. Data from the Beek Research Institute shows that in the rental transactions of 40 key cities in China, the proportion of tenants aged 35 and above exceeded 35% in 2023, an increase of 4.9 percentage points from 2021, even surpassing the proportion of tenants under 25 years old. Particularly in first-tier cities, this trend of increased proportion is more pronounced. Statistics reveal that an increasing number of middle-aged individuals aged 35 and above are rejoining or joining the ranks of renters. Simultaneously, there is a growing number of posts on various social media platforms discussing selling the house at 35 and renting with the family or middle-aged renting transformation. An analysis by the well-known Chinese public account and new media platform, Glacier Think Tank, on February 5, pointed out that many individuals selling their houses to rent are around the age of 35, primarily due to real-life pressures and discomfort. Firstly, the pressure for mortgage payments makes it difficult for many middle-aged individuals to breathe. Many people have stated that after calculations, they found that the interest on loans to be repaid over several decades is close to the principal amount. Selling the house not only provides a cash infusion but also eliminates future repayment pressure. The cash obtained from selling the house also provides some security for the family's livelihood in the coming years, alleviating anxiety. A property agent in Zhengzhou revealed to the media that due to a decrease in second-hand house prices by 20% to 30% compared to previous years, some homeowners are unable to pay their mortgages and reluctantly opt for free house giveaways. As long as the buyer is willing to take over the mortgage, the house is directly transferred to them. Additionally, as individuals age, they face various expenses such as child-rearing, education, and elderly care, which make economic pressure increasingly burdensome. Furthermore, in the current downturn in the real estate market, the sense of security previously provided by owning a house may instead transform into anxiety about asset depreciation. The Glacier think tank believes that after homeowners sell their houses at a reduced price, although they may lose hundreds of thousands in terms of purchase price, interest, and renovation costs, they gain peace of mind and cash after selling. The article suggests that selling houses and going rent may face misunderstanding or even opposition from parents, relatives, and friends. However, under the basic goal of survival, these nominal successes ultimately give way to the basic needs of existence. Powell, China's economy facing challenges, shifts away from market-led growth model. On Sunday, February 4th, during an interview aired on CBS's 60 Minutes, Federal Reserve Chairman Jerome Powell addressed topics including the Fed's expected interest rate cuts and the threats posed by the Chinese economy and global economy. He stated that the Chinese economy is currently facing challenges and has shifted away from a market-led growth model. Powell said, "It's clear that the Chinese economy is facing some challenges. And growth has slowed. They have moved away from a market-led growth model. It's now more state-owned enterprises. And there's still too much linkage to things like real estate investment in the Chinese economy." This month, a court in Hong Kong ordered China's largest real estate company, Evergrande, to undergo liquidation. Evergrande failed to restructure its $300 billion debt owed to banks and bondholders, $25.4 billion of which is owed to foreign creditors. Currently, many other real estate developers in China are heavily indebted. However, Powell quickly shifted the conversation back to the U.S. economy. He said, "What is the impact of problems in Chinese commercial real estate on the U.S.?" He explained that while the economic relationship between the U.S. and China is important, it mainly revolves around the U.S. purchasing Chinese products. Therefore, the U.S. financial system is not deeply intertwined with China's financial system. Powell said, "Our economy, our production system is not deeply intertwined with theirs, so, as long as what happens in China doesn't cause significant disruption to their economy or their financial system, then the impact on us, we might feel some, but it won't be that great." Don't forget to leave a comment in the section below to share your opinions on today's topic with us. Make sure to like and subscribe to see more interesting topics from China Truths.